Guys, thank you for joining us today. This is going to be a webinar on the long call calendar. And one thing I say at the beginning of all these, and I know a lot of you guys that I was chatting with at the beginning of this have heard this time and time again, watch it again. Because if it's been a while since you've learned about the calendar, you're going to forget some of the nuances, especially the way I teach it. I know you can go online and learn about the long call calendar. You can figure that out by just looking it up online. It's basically a horizontal spread. That's pretty easy. But at the end of the day, these guys are not going to tell you strike location, probabilities, and when the right environment is that we were even just talking about before this went off was to put on any one of the strategies I talk about. I talk about specifics that these guys online aren't going to tell you about. So hopefully I can add some value to you guys, your learning process, if you will. All right, so without further ado, let me get a couple of things out of the way first. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with a psychology degree, believe it or not. I actually had some money in a bank, and the discount brokerage guy called me up and said, hey, you want to put some of this stuff to work? And I ended up buying some stocks, and then further along started selling calls against it. In hindsight, I wish I would have, when I got that stuff called away, sold the puts and then got stock put to me and all of that stuff, but that's neither here nor there. I always just ended up going back, buying the stock, selling calls, and playing it that way. But then after graduating, I actually switched over to a finance degree midway through, and then moved to Chicago, started working as a runner. Those guys that are running around with a paper, handing them into the pit, sold all my stocks, bought my badge, and jumped in there and started trading from there. So in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products, basically in all market conditions. I wasn't old enough to trade the 87 crash, which we are a 30 years and 1 day anniversary, I guess, if you will, from that. But just about everything from that time in the 90s all the way till now, I've been full on in the markets just about every single day. This basically says a disclaimer here. Any opinions, news, research, and analysis or other information contained here are material provided by Pro Trader Strategies Associated Companies is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of the securities or strategy. I'm sure you guys have heard this before, but I have to go over it. What this basically says is because I don't know your risk parameters, I don't know what's in your portfolios, I can't really give you investment advice. And that's true. That anybody out there that's basically cherry picking their best trades and telling you that, you should go out there and put that in your portfolio, it may not be suitable for you and may exceed your risk parameters. So you need to kind of take all this stuff into your own account and make sure that you make your own decisions. And bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. And part of this all goes back to like Farshad and I were talking about. He was saying, with the naked strategies that I love to do are, risky, and you can lose a lot of money on those sometimes. And that's true. But, even with the long call spread, you can lose a lot of money on those. As a matter of fact, if you guys watch the daily market commentaries, you guys saw I lost a nice chunk of change on Adobe blasting out. So, that is the risks we take when we're trading. So, not just because it's defined doesn't necessarily mean it's not risky and or that it's not possible to be expensive. So it is true. Trevor's asking, do I have any regrets? Regrets on my life? No, I don't have any regrets. As a matter of fact, if you make a mistake, it's a learning experience. And no, I don't regret going to the board of trade and working on the floor. That was probably one of the best things the best decision I ever made. That was the funnest job I've ever had too. So besides this, you guys, I love doing this with you guys too. So not becoming a doctor, no. I was going to be a doctor, Trevor, but I just didn't have the patience. Um, anyway, you guys can follow me on Twitter at Wolfman's blog or at our parent company at ProTraderStrat. Right now is a good time to follow me because I'm talking about earnings, trades, and stuff like that I'm putting on, when I'm putting them on, and who I'm doing them with. So, or what companies I'm doing them with anyway. All right, so on to the long call calendar. Now, there's a couple of things to do before we set this thing up, knowing exactly what we're doing. A call calendar really is a horizontal spread. When we're talking about like short call spreads, long call spreads, those are vertical spreads, meaning the mental picture you can get from this is on the options chain. When we're looking at the options chain, basically, I can pull up my thing is, my trading platform didn't crash, but anyway, hold on, I'll wait for it to load up. Basically, a vertical spread is on the options chain, up and down. You have your strikes that go across this way. Well, vertical, you can think of it this way. Horizontal is horizontal on the calendar line. So we're going to be selling the same strike in this. But one thing you can do, the reason why I have the at the money or the just out of the money, it really kind of is going to lean towards your directional assumption, okay? If you're more neutral, like a lot of times I like to put this on when the market's kind of made a big move. I think there might be a little bit of a slight correction happening where the market might roll over just a little bit and then continue on its upward trajectory. That's like the perfect scenario for this, believe it or not. Excuse me. Because we want those front month options to decay, and we don't really want them to go into the money, because then you have all kinds of other risks, like having the stock, called away from you and things of that nature. And if you don't have that stock, then you're basically short that stock. So we don't necessarily want that to happen. But if the market kind of rolls over a little bit and then continues on, that's going to give us a strong probability that our front month options are going to decay worthless. The other thing is, if you're slightly bullish on this, like, hey, this thing's in an upward trend and I think it's going to continue on that, then you're going to pick this slightly out of the money. So you're selling the at the money strike, and it's going to be the same one as you're buying in the further expiration cycle. Or if you're doing the out of the money, which would be more along the lines of somewhere between the right 36, 30 delta, depending on how bullish you are on that. That's how you're going to discern this. If I'm thinking it's going to kind of roll over, I'm going to get a little bit closer to at the money. And if I'm a little bit more bullish in this underlying, then you go a little bit further out. I don't like to go any further out than the 30 delta, you guys. I think that with this strategy, you get too far out, you're going to your probabilities are really not in your favor anymore. So 30 is about as far as I'm going to go out. 36 would be the sweet spot for my out of the monies. The at the monies, they're the ones that are just going to be slightly out of the money. Around a 45 delta is kind of what I pick for these. So about a 45 delta here, or if I'm going out of the money, about a 36 delta. And I'll go into that in a little bit more detail. Now you're a teacher with crossed pupils. That's right. Exactly. I can actually make one eye go straight and cross one eye, believe it or not. I can do that with both of my eyes. All right, so just a fun fact about the Wolfman is I can cross one eye and make one eye go straight in either eye. All right, so moving along. All right, the essentials to success, picking the right underlying. You guys, this is one of the ultimate, most important, highlight. You don't go any further if it doesn't meet this rule kind of thing, okay? And when I talk about picking the right underlying, it really means the options in and around that underlying. It has to have a lot of volume and open interest. If you are in something like a stock that nobody's ever heard of, there's nobody ever going to be in that underlying either. So, or in that, options. Whereas even some of the more popular ones, like we could say something along like Aon or something like that, where everybody's heard of, there's just nobody in there trading those options. So make sure that when you're trading these things, that we are in a stock that there's a lot of participation in. All right, I finally found my trading platform. So what we can do is we could go in and look at, something like Aon for the, just because I last mentioned it, there's a lot, everybody's heard of Aon, but we go into the options and blow this up, and you can see that there is nobody trading these options. This is 28 days to go. So this is basically the front month, and there's just nobody trading Aon options. Okay, so stay away from it. So the rule here is any stock under $100, the bid to the ask needs to be inside of 10 cents. Well, this one's over $100 stock, so my rule is on a stock over $100, move the decimal 3 ticks to the left, and the bid ask should be 15 cents wide, and it fits it here, but that's not a very good, market for any of these. So 15 cents there, that's a stretch. If it fits that in a couple of them, flip on volume and open interest, and you can see you don't want to be in here. 2 contracts have traded there, 18 there. That just, the reason why is because whoever is making the markets in this underlying is going to make you, if you're buying it, pay $1. And you could go 2 weeks in this strategy and the market goes in your direction, but theta decay gets out, and now it's like, you're basically getting out for where you got in. So this market could have rallied. Now it's $1 bid, and it's like any other market, that'd probably be $1.10 or $1.15 bid or whatever. But in Aon, because nobody's in there, you're going to have to give up so much edge to get out. So you could look at something that's comparably priced, and I think Apple's trading right around here. So let's just look at Apple as an example. Apple, for those same options, you can look at the massive open interest here, massive volume, bid ask 5 cents wide. In some cases, you'll see it like 2 or 3 cents wide in Apple when, in the middle of the day. It's a Friday after the close, and a lot of people cancel stuff, but you can see that the bid ask is much tighter, a lot of open interest. And beauty in this is I could come in here and bid 254 or maybe even 255, give up 1 or 2 pennies, and somebody is going to come in and hit me because there's so much going on, because the person sitting at 259 is like, all right, fine, I'll give up edge here, and you kind of meet within a couple of pennies where you started out. Whereas that other one, you're probably going to have to give up almost everything to get in. So make sure that bid ask is tight, a lot of volume and open interest for any particular underlying, for that matter. All right, so the next thing we want to look at, if we found one that has tight bid ask, picking the right strike with this strategy, it's going to come down to your assumption. All right, if you have no directional assumption, or you think it might go a little bit down, maybe it's topped out a little bit, we're picking the 45 delta out of the money option. If you're a little bit even more bearish, maybe you're picking that right at the money option. But I like to go for the 45 delta option. And then if I'm a little more bullish, I'll stretch it out to like the 36 or so. Okay. All right. And then picking the right duration. With the right duration, it's a little bit more difficult because we're basically picking two in a row. Okay. But one of the things I like to say about picking the right duration in this one is the option that we're buying. That's the one we want to have volatility expand. All right. And that's important because anytime we're buying an option, we want that option to increase in value. And one of the best ways to get increase in value is when volatility expands. So one great thing about this one, and I know a lot of you guys were watching those earnings webinars that I did, outside of earnings, earnings, you get that expansion and volatility. And then right after that earnings, it just crushes, which is a beauty. And trading those, you know exactly when that's going to happen. Well, how do we know when option volatility is going to expand? One of the things is around earnings. So this is a great strategy to set up when we're coming out of earnings. We're kind of getting right into the meat of earnings right now. But this next month, after next month, or this next earnings cycle that we're getting ready to get right into the heart of, it's great setting this up right after those earnings that those stocks you really like to play, because that when we're buying should feel expansion and volatility going into that earnings event. And by that time, our short call is gone, and it's basically financed most of our value of these long calls. And that's the beauty in this also is, we can get long duration calls on for pretty cheap because we're financing them with this front month. Okay. So what we're trying to do is we're trying to exploit that theta decay happening. So we're selling the option that is in this theta decay, and we're buying the one back here that, isn't decaying quite as rapidly. So it holds on to its value a little bit longer. And then what we're looking to have happen is once we start getting closer to that earnings, is that volatility is going to increase. If I can get my pin to work. So volatility is going to kind of push up on this slope, this theta decay. And what it does is it causes this line to kind of flatten out like a balloon, and it is the best way I like to describe it, is when you blow up a balloon, that's like volatility inflating the market. That the more you blow it up, it looks like that curvature kind of flattens, if you will. It doesn't necessarily flatten, completely flat, obviously, but it gets that feeling where it rounds off quite a bit. And then that's when we're going to get out of it, because if you go too far into it, you don't want to take that long call into the earnings unless it's basically a loser at that point. Then I would write it in because you got nothing else to lose, right? But if this is a winner, I would not write it into the earnings, because when the volatility comes out of that, that's your premium. And you could be directionally right, but you have to make up for that in price movement. And we don't want to take that risk. It's a bird in the hand, you guys. Don't try and squeeze out every last penny. I mean, one of the things with this strategy is, in a sense, the profit is unlimited, but anytime, here you go. This one thing that we used to say on the floor was bulls and bears make money, but pigs get slaughtered. So keep that in mind. Don't be a pig. Get out quickly in any option strategy. And this is a real reason to get out of it, because we'll see that options volatility and premium come out of these options. So get out early. Now, if it's already a loser, you had a long call calendar on, that short call maybe expired worthless. The market kept going down. Now we're going into earnings, and my option is out of the money. Well, if you're down money on it, then maybe it's decayed 75%. Maybe you paid $1 for it, let's say, and it's trading for a quarter. Well, then there's no real, in my book, there's no real reason. You've already taken that much risk and that much heat. You might as well just take it into the sunset and see what happens, and hopefully that they have good earnings. I mean, you were bullish this stock for a particular reason, and maybe it's because you think they're going to do well in earnings. So that would be one of the few cases that I would leave it on. If I'm at a scratch going into that earnings, I'm going to count that as a win. I count a scratch as a win, you guys. And then picking the right environment. One of the things with this one here is, not only do we want that earnings happening in that long dated option, we want low volatility when we get into this strategy. We want about as low volatility as you can get. Now, normally when I'm talking about selling options, I like to have a high volatility. Well, in this, we want low volatility, or at least the volatility in the month we're selling is relative to the volatility in the option we're buying. The reason why is the further out on the chain you go, or the expiration cycles you go, volatility affects those a little bit more. So when we're moving out there, and especially when we're picking an option cycle that has the earnings in it, there's going to be a discrepancy in the amount of volume that we see in that front month and the amount of volume we see in that back month. So for instance, for this one, what we're going to be looking at is this volatility. Now, I know I usually talk about implied volatility percent, 91. Now, right off the bat, I already talked about it. We want low implied volatility percent to begin with. And it has an option cycle happening in this month here. So let's skip over that and look at something that's already had their option, maybe even like eBay. It just had its options. It just had its earnings. But with XLE, let's take a look at it. What we want is whatever option we're buying and whatever option we're buying and whatever option we're selling, we want this volatility over here to be relative to one another. Now, what does that mean? It means at least close. Best case scenario would be have something like this, where the one we're selling has higher volatility than the one we're buying. Because what that means is you're paying less relative to what you're selling, right? Because we talked about this. Volatility pumps up premiums. So if volatility in the month I'm selling is higher than the volatility in the month I'm buying, yes, you are still going to be paying a debit, but keep in mind that volatility in that front one has more premium pumped into it because of that volatility than the one we're buying. So great example of, we would love to be buying this one buying this one and selling this one because we're getting paid for volatility there, and we're not paying as much for volatility here. So keep that in mind. That's a little bit tight for me on a calendar spread, but the rule here is 2% or less. Now, sometimes, and that's basically been in the last 3-4 years where we've had pretty low implied volatility across the board. If we start getting into a situation where, implied volatility remains the VIX remains up, around 15, 16 on, long-term basis, then this rule could be stretched out to 3. But less than a 2% difference between the one we're selling and the one we're buying, because we don't want to be paying too much for this premium in here, okay? So we're going to be trying to get this less than 2% between the Dec and the Jan. You can see this is basically 1.5, okay? See, 10, let's just say 10 to 11.5, that's 1.5 percentage points difference. So that's a little bit of a rule of thumb there, okay? And I stick to that pretty tight, where, if I really love the trade, I might go out to 3, but outside of 3, I'm just not going to do it, because then you're paying a lot for this premium. And your risk reward is going to be kind of inverted, where you're going to be risking more in premium than what your, one of your theoretical max profit is, in a sense. And one rule here is also, while I'm thinking about it, is we're looking to risk 1 to make 2, and that's when we pull this up on the Analyze tab. I'll show you a little bit more about how we're looking at that. Risk 1 to make 1's good. That's kind of like a yellow light. Risk 1 to make 2 on the Analyze tab, when it shows that is like a green light in my eyes. So that's what we're looking for in that type of scenario. And we have to know our exit strategy. I mentioned this. I know a lot of you guys are returning. One thing I mentioned about this one, write down every strategy you put on, what day you put it on, and why you put it on. And keep a log on like a 3-ring binder, or a multi-ring binder notebook or something like that. And write it down. And then when you get out of it, write down why you got out of it, where you got out of it, whether it was a profit or loss, what situation around that underlying caused it to be a winner or a loser. But one of the most important things is when you write down what you're going to do with that strategy, what you've done, know where you're getting out. You're more likely to get out of the strategy when you've written it down at your profit target than if it's in your head. If it's in your head, you're going to kind of be like, yeah, well, I'm going to let this ride out just a little bit longer. And believe it or not, that's usually when you're being a pig and pigs get slaughtered, right? So what are the things I look at for this one? An increase in value of 30 to 50%. That's when I'm looking to get out of this. A 30 to 50% increase in value. Now, if we're doing something like Priceline, I might be like looking at it like 10 to 25%. But I'm talking for the most part stocks, anywhere between 75 and 300 or something like that. I'm looking at it like a 30 to 50% increase in value in that underlying or in that premium. So for instance, just an easy example, if we paid $1 for this, we'd be looking to get out between $1.30 and $1.50. On the higher priced ones like the price lines, we're going to be paying a few dollars. So I'd be willing to take 20% increase in value. But write that down. Hey, the reason why I'm willing to take 20% only on this one is because, for one, maybe I'm not super sure. We're at all-time highs, and the market could correct. So I want to take singles and rather than the doubles and triples. Okay, and I'm a guy that doesn't swing for home runs, you guys. I'm an on-base percentage guy. I'd like to rather have a 90% on-base percentage than have, a 10% home run rate. Because I think your longevity is key to success, and key to that success is having an on-base percentage. All right, so is everybody clear on that one? If we're directionally wrong, it's defined risk strategy. If I'm paying $1 for it, I'm probably riding this one out, especially if I've gotten it into that earnings. Okay, if I've gotten that earnings involvement with this long call, then I'm probably riding that out. And I see you guys are blowing me up, so before we get in the profit or loss, I'll try and nail a few of these. How do you forecast the expansion of volatility? Great question, Caesar. One of the things we know is when there's a binary event, there's going to be volatility increase. How much it increases, we don't always know. And a binary event is simply just an event we know that is around that underlying, So for the treasuries, they have a binary event. It's the FOMC, okay? And banks are going to have that binary event too of the FOMC when there's an FOMC meeting. If you look at volatility of, let's say, Apple or any of these other ones, you can see volatility ratchets up into the earnings. Earnings happen, boom, there's nothing else there because everybody knows what's going on in and around Apple, at least for the next several months. Whereas banks have a tendency to kind of juke all around when we're looking at that volatility, and that has to do with all these FOMCs and stuff like that going on in and around that. And, they're data dependent as well. Increasing interest rates is good for them and decreasing interest rates is bad for them. So they kind of get in on the economic data as well. But that's one of the best ways to know we're going to see expansion and volatility. So that's why I like to set this one up in and around that one that I'm buying has an earnings event in it. And the other thing is when we have really low implied volatility, like some of the ones that we're going to be looking at have zero implied volatility. Well, that means it's at the lowest implied volatility it's seen over at least the last year. Well, it doesn't mean it can't go any lower, but the probabilities are now that the volatility will increase. And volatility has a tendency to revert back to the mean, which doesn't necessarily mean how much time it's spent at certain levels. It doesn't take that into account. It just takes into account the high and the low and where it is now in relation to the low. And it has a tendency to come back to those. It's like a magnet, if you will. So if it's at 0, probabilities are it's going to go back up, at least to 15, maybe 30. And if it's up above 50, it's going to have a tendency to revert back down to like the teens. Teens are kind of like the sweet spot for them, generally speaking. And I'll show you guys how to do implied volatility percent in a minute. What was the other question I knew I saw? How do you select the right expiration from all of the cycles? Trevor, good question. That we are going to be trying to pick the option expiration that has an earnings event in it, in the one we're buying, and there's not very many good examples, let me tell you, because we're in the midst of earnings. But that's the idea, is to try and buy that option that has the earnings event in it, and we're selling the event or the option cycles that do not have any event in them. So that's how we try and set that up. Otherwise, we're just going to look for super low implied volatility and expect it to expand. And if it does expand for us, volatility expands and we're still short that call, remember that further out on that options chain, you guys, is being affected by volatility more than the ones that are closer on the options expiration cycle. So volatility can expand, but it's likely going to expand more quickly in those back months than the front months. I think I saw a couple other ones, but it's hard for me to read and talk at the same time. Believe it or not, I don't even know if you'd call that ambidextrous, but how do you select the rate expiration from the different, okay, I answered that one. I think that was a double question. How far away from earnings do you recommend? Caesar, I like to go in right after the earnings season and start setting these up generally. But, I've been talking a lot about earnings setups. So when you guys have gone through that, this is like the next step. So, I do this pretty religiously where, I clean up my portfolio getting ready for earnings. So I have margin available, like cash available to put on any options strategy in and around earnings. And then once that's over, we go through a period of pretty low implied volatility, and it's the time to put this on, because then you can play expansion and volatility. So you can be even directionally wrong in regard of selling options premium and still be right. Well, this one, if you're ever buying options, you really need to have a lot of things go in your favor. One is directionality, obviously. Everybody knows that one as a simple rule of thumb. But two, to help you along the way and to hold off theta decay, which is what we all see in those options premiums when we're buying them. We used to say theta was the thief in the night that came and stole your premiums. Well, volatility expansion is kind of like the guard that fights that off. All right, you got a big guy kind of holding that off, and volatility increasing kind of inflates those premiums in a sense. Just trying to give you some bizarre, I guess, visuals, but Vega fights off theta in a sense, synthetically speaking, I guess. All right, so did I go over this? Max profit is unlimited. That's because it's very difficult to discern what your max profit is on this particular one, because the options expiration cycles are different, and we are long an option and the further duration. So if we let that options expire a front month, then we do have unlimited profitability to the backside. But I'm going to show you a couple other things to really, the easiest way to get your max profit on this is with the Analyze tab, rather than pulling up a 9,000 page algebraic computation. All right. But the other thing is, don't be a hero in this. We're managing for small profits. If it's a loser, then I would write it into the earnings if it were involved. And then max loss is always the premium you paid. Okay, you can't lose any more on any option strategy than the premium you pay. If you pay out a debit, that is your risk. And then the break even is going to be that long option plus the premium we paid. So if we bought the 100 calls in that further expiration and we sold the 100 calls in the November expiration, then and we paid $1, well, our break even is when the underlying reaches 101. So it's that long option plus the premium paid. Pretty simple. All right, so without further ado, let's pull up the fun part of the webinar. At least I hope it is. Not that I haven't been a blast already. But I think you get a little bit more out of it this way. And this is where I usually throw it out to you guys. Throw out some stocks that you guys like to look at, and I'll run through my rules just like I went through on these setup, like the essentials to success, and we'll go through it step by step to see if it fits with my rules and whether or not it's a good opportunity for something to put on Monday. And as a matter of fact, in the daily market commentaries, whenever I do a Friday webinar, 90% of the time I'm putting on a strategy on that Monday that we talked about in the webinar. And I actually even do in the daily market commentaries. I haven't done one for the calendar this time, but a lot of times when I'm leading up to the webinar, I'm putting on a couple of those strategies as well. Okay, people are blowing me up. All right, hold on. Let me catch up with a couple of questions and then I'll get to you guys real quick. Won't volatility in the front month slow down the theta decay? No, front month, well, if you get expansion in volatility in that front month, yes, it will slow down the theta decay synthetically of that front month. But like I said, volatility affects further duration options more than the nearer options. So it's going to outpace that. First time, will this be recorded? Yes, it will be recorded. And even if you guys were here for the whole thing, I always suggest watch this again relatively soon, like within a couple of days, so that the nuances stick in your head. Because if you watch it today and 2 months down the road, you're kind of like, or even after this next month, after the earnings, you're like, oh, Wolfman said I need to put on do some calendar spreads because this is the time to do it. Well, wait, what were those rules? But if you watch it again, you're going to have more of a long-term memory for it. First time through, it goes to short-term memory. Second time through, it tries to stick it in that long-term memory anyway. Okay, so let's go to Facebook. Was eating birthday cake. Happy birthday, Chuck. At least if it is your birthday. Please send a link for the replay recorded. We do. We send it out. It usually comes out tomorrow morning. Sometimes it'll come out this evening. But because I'm on West Coast and a lot of people are on East Coast, I think it has a better opportunity to get out on Saturday morning because it takes me a while to compress these, convert it, send it, or upload it, send out the heads up that it's done. And, a lot of times that can be well past somebody's Friday evening. So it will come out either today or tomorrow. All right, so, and the link for the daily market commentary. You know what? I'll give you an email, guys, that you guys can reach out to us for that. Because I talk about every single trade, you guys, that I do. And I've been doing more talking about my IRA too, because a lot of people are like, hey, I only really trade my IRA. So I've been trying to trade more, or at least talk about my IRA more, and putting trades on in there. So I've actually switched that out. It was like one of those things where my high risk was in my trading portfolio, my margin account, which I knew, and because I have a high risk tolerance, and my IRA was kind of that one that I didn't watch because I knew that it was very low risk. So it was kind of my yin and yang. But I've taken it over, so I've probably increased my risk rating somewhere along the lines by doing that. But I'm actually doing better than what they were doing in it, so I'm okay with that. Anyway, so let's look at Facebook. First one was the first one I saw, Facebook. All right, so Facebook, and this is going to be hard because Facebook has earnings coming out, and one way you guys can tell when exactly the earnings are is by looking at the one that has the highest implied volatility. So their earnings are within the next week or so. So you can see that this has the highest also. I mean, this is the very highest because that's the one that really is nailing the earnings. And the November is going to have that earnings in it also. Having said that, you're going to get high implied volatility for this, right? So that means we're going to get paid more for this selling part of our strategy than the one we're buying by 3 percentage points or 4 percentage points almost. 3%, a little over 3 percentage points, or actually almost 3 percentage points. But where am I going with that? But we have to take that risk on, and we're going pretty close to at the money, and I don't like to take that risk in that front one necessarily. So I like to play it where this one has the earnings in it. But if you can ever find a situation where it's clean, meaning there's no events, and you can get more, this is higher than this one, then that's a green light also. But the red light on this one is that it has that earnings event in it. But if you can ever get the front month higher than the back month, then that's a good deal. So Facebook will have to bypass on it. Another one was Google. I could do the L one too. I see you actually asked for the Google with the L. So $1,000 stock. One thing we go to look at is how tight is the bid ask on this. I don't know why I have all of them. Wait, I'm going to go down because we don't need all that many. It's got 84 IV%, but they also have earnings in it. But again, if you could ever find this being a clean month and higher than that one, then that would be good for that particular one. All right. So, and Google is one of those ones where it's $1,000 stock. They usually have inside, they're like 50 cents usually. But again, it's a Friday and they've gotten a little wide. But Google has it. So let's go to a couple of ETFs that I saw come up. What was it? I think I saw somebody say USO. USO is one of those ones where it's a little bit, it's a cheap play, but we can do it. So let's, especially if you have a lower account size, this would be a good one to do it in. So really low implied volatility. You can see this spike here. So this is another reason why to know that how to figure out implied volatility percent. And getting that above 50%, below 50%, there's a numerator and a denominator, right? So in the numerator, we have a sum. In the denominator, we have a sum. In the numerator, on the top, we take where the current implied volatility is, and in this case, it's 24. And then we subtract that by the low, which is basically 23. So, we could say 1. And then you divide that by the high, which is 55, minus the low, which is 23. So, basically you got 1 divided by 23. So it'd be basically in the 1 percentile, which is what we're getting there. But you can see that this is a massive anomaly. And you'll see this in other stocks also, like Lilly and things like that, especially the drug makers, because they have these trials and volatility goes through the roof when they come out with their results. But, one thing to do is, kind of erase that out of it and then figure it out and go with the implied volatility percent math. Take out that anomaly. Like I mentioned with Lilly, you'll see that Lilly has a tendency to kind of spike all over the place. This was a trial that they had that failed, but I mean, you can see that that is a massive spike in implied volatility. But look, if I take this out, it becomes a little bit more normalized, where this, I might even say, was the high. So you can do that math where you go, okay, well, 18 minus 14. So we got 4 in the numerator. In the denominator, we take the high, which we could say is like right around here, 27 minus 14. So 27 minus 14 is 13. So we had 4 divided by 13. So it's still only, it's low. It's like what is that, a 25 IV percent, just off the top of my head. Just I'm sure that's close, but not exact. But then we can look at when their earnings are, and I think they actually have earnings, but I just wanted to give you an example of the anomaly. So they actually don't have earnings coming in there, so it actually might work out. You have to know this stock pretty good because it can have a tendency, it's a $80 stock, it can have 20-cent wide markets sometimes. Usually it's pretty close to 10 cents, but you can see they have decent volume and decent open interest, but let's skip over that one. Let's go back to the USO one. So USO, we got to look at it. How close is it? 23 to 28. Nope, that doesn't work. Let's look at something everybody probably doesn't know. Let's go look at IWM. I don't have any IWM. Now, there is stocks in here, you guys, that I may very well have in my portfolio. And remember the disclaimer, I'm not trying to get you guys to lemming off the cliff with me. It's just because that's what fits my portfolio and what I'm seeing, what I see working. IWM, this has a lot of volume and open interest, $150 ETF, and bid asks 3 cents wide. All right, so let's look at the volatility. It's got a 13.52 here, a 15.11 here. It's got really low implied volatility, as you can see. Aside from this one little down spike here, you could almost say it's at the lows, so very low implied volatility. And as you can see, it probably, if I just drew a line where it trades the most, I would have to say it's either there or relatively like this. If you wanted to look at a support resistance, you can see that would act as support earlier on in the year and acts as resistance now, but that's where I would expect it to want to go, and or at least revert back there. It doesn't necessarily mean it's going to do that, but to me that means it's going to want to go back towards there. What platform am I using? This is Thinkorswim, TD Ameritrade's trading platform. Okay, what do you mean by a clean month? Okay, Patricia, so these red lines here are all the different option expirations. And as you can see, there's nothing down here. It doesn't show any events, and that's because it's an ETF. But if we were to look at something like UAL, this is not a clean month. This has earnings in it, and that means it has something going on. It's a binary event. This would be a clean month. This would be a clean month. It just means that there's nothing going on in there. And if we look at something like the JP Morgan that I mentioned earlier, they just had earnings. Why is that? Am I on a daily? I guess I didn't. Oh, because I don't. JMP, dyslexia. JP Morgan. So you can see how volatile this bank stock looks. Like it rallies up, but I can almost assure you that these ramp ups in volatility here are where we are seeing the FOMC meetings. And that's why it gets janky in between there. We could say they just had earnings, but now, there's a December meeting, but I think there's also we just had a September meeting. And I think there's one at the very beginning of November. So we would have two options that basically had binary events in them. I don't expect them to raise rates, so it might not hurt that much, but that's what I mean by a clean month. And this one looks like it has clean months, but there was a likely a FOMC in those ones where there's spikes. Okay, so IWM, first thing we look for is, does it have the right is it the right underlying? Well, we can see there's volume and open interest out the yin yang, and then picking the right strikes. Well, there's not really a binary event in this one, but we have really low implied volatility, and my expectation is volatility will increase. So that fits that rule. Now we need to look at our deltas, right? We need to figure out that 40, how bullish are we? I like to pick the 45 delta because especially we've been in a bull trend. So I would pick something like this one. If I'm even more bullish, if you guys are like, oh, you know what, to have it only go up to 151, sorry, okay, to go up to 151, that is a new all-time high, but everything's been all-time high every single day. So maybe we want to pick something a little bit higher if we're a little bit more bullish. So, that might be the case where then I go, okay, I'm going out to that 36 delta, 30-ish at the most, okay? So that's how I kind of build this out. I start out with the 45. How bullish am I? If I was more bearish in the near term, then I'd probably go towards this one. But that might have been yesterday or the day before because I was thinking this was going to roll over a little bit more. But now that it's kind of popped up again, and if we look at the S&Ps and things of that nature, that didn't happen. So to me, this could start moving back even higher, and the economic data is kind of supporting that. So I would more likely kind of go out, maybe even do this 30 delta just out of the money. Anything outside of this, I'm not gonna ever do these 25s that far out. So I would go to sell these 30s because I'm more bullish in that regard, and then picking the same strike, the 152s, buy that one. So we're paying $1 for this strategy. Now, with IWM, as tight as it is, and we saw how much volume and open interest in it is, I like to get away from it because, you guys, there is nothing that holds you back. It costs you nothing to enter a trade and then let it work for 5-10 seconds, go into your monitor tab, cancel, replace, move it up, cancel, replace, and move it up like a penny or two, cancel, replace, let it set for 5 seconds or so, cancel. Basically, by the time you go back there, you'll know whether or not you're getting that. And, I always look at it like if I put it in the first time and I get filled, I may have left some money on the table. And those are situations over the course of your career are going to make big differences in the amount of money you've made, believe it or not. Those are like little pennies you're leaving everywhere, and I don't like to do that. All right, so, or those 1 or 2 pennies could pay for the commissions of what your trade was. So just always be conscious of that. It costs you nothing to cancel, replace, but if you get filled on that first one, you might have left some money on the table. All right, so let's look at the Analyze tab because I haven't gotten to that yet. Go over to Analyze. Platform wants to work. So one of the things I like to look at and make it a little easier to look at this on a one lot, just to keep that in mind. I said a yellow light is risk 1 to make 1. You can see here on the Analyze tab, we're looking at risking $1 on the downside to make about $1. So that is pretty close to risking 1 to make 1. Now, the reason why I was mentioning that we want this in a low implied volatility. So this is a volatility adjustment. What this is, it's increasing the volatility percent by 1%. And so, you know, like a 1% increase on a IV percent of 12 is really, you know, just going to 13. It's not really increasing it by, you know, 0.50 to make this to go to 1287. So that's a little misleading, but you just watch the peak here, and if volatility were to increase on it, and I'm not taking into account the theta decay and stuff like that, I just want to give you guys a visual as to what happens with this strategy if we get that volatility expansion we hope for. Okay, so even with nothing else happening and volatility just increases, we don't risk anymore to the downside in that regard, but our max profit potential increases because that back month is getting affected by volatility more so than the front month. And in the flip side, you know, we don't want to see that volatility contract on us necessarily, which is why we're trying to pick that one with a earnings event in it, because we know volatility is going to expand in that one at some point. But that's why we don't want that volatility to decrease. Does that give you guys a good visual as to why we want that volatility to expand? How come the Vega we are selling is lower than the one we're buying? Because volatility has the effect more so on the further duration than the ones that are nearer term. How do you add green light standard deviation on the chart? Well, this I don't have a green light necessarily for the standard deviation on it, but this is, you flip this over to standard deviation and it's not going to give me the right ones, but the gray area here is the one standard deviation move. And if I switch this over to that being positive and that being negative, you can see those line up. And you know what will happen is if that back month has a lower volatility than the front month one that you're playing in, you'll see these red lines being very close to the standard deviation. And the other thing is you can see this is where we are right now. The peak is a little bit higher, so I am bullish this underlying like immediately. In the case you are buying the earnings month or selling, you're buying the earnings month and you're selling the clean month. Oh, you mean on the chat? I'm sorry. Oh, when I was talking a green light, those are just some of my rules of thumb to go with it. So with like, I always have like a red light, green light kind of thing. Red light, green light, and a yellow light's kind of like I'm neutral on it. It fits everything, but I got to really want to put that trade on. But there's times where I'm just going through and like looking at different underlyings, and all of a sudden I'll see something like that where the volatility in the front month is higher than the volatility in the back month. Well, all of a sudden that sends off a green light for me. That's a great strategy for the calendar. And then I'm going to go in and dig a little deeper on that to see if there's a binary event, things of that nature, to discern whether or not I want to put that on. So I kind of throw those red light, green lights out in a lot of these webinars. But green light means like I'm going to do everything in my power to try and get this strategy on. Yes, Patricia, no binary event in the clean months. I think I got everybody. All right, I think I got everybody's questions on that so far. Okay, so I thought there was one other thing I wanted to chat about on this. Oh, no, I kind of mentioned it. But yeah, the closer these are to the one standard deviation move, our break-even areas, that's what we kind of want. And that's what we're really looking for. So I'm probably, if you guys watch the daily market commentaries, you saw I put on a a long straddle, which I almost never do because I was like, this stuff is just really winding tight and it's got to break out one way or the other. It's got to go one direction or the other. It was kind of like this whole thing, and we can look at SPY. You know, we're looking for that because that's the probabilities of something like that happening. I don't know why it came up, but and that's why you have that in and around everything, you know, really low implied volatility. The market's kind of been really strung out. So I talk about those kind of nuances in all the different webinars is what I want to kind of get at, and that goes down to the red light, green light, and that was like a real green light. I don't like to buy straddles. That's probably one of my least favorite things to do, but you know, in the environment we're in, you know, we have to trade what we're given, and that was the highest probability strategy I could put on for the situation we were in. So you know, that I just trade what they're giving me, and I talk about that in those daily market commentaries, which I would, you know, really suggest you guys take advantage of. But this is the deal we're giving out, $36 for our earnings course. We're right in the thick of earnings. You guys still have enough time to kind of view over these. There's over 10 hours and like 8 different webinars on all my favorite strategies I implement in and around earnings, and when is the appropriate time for that strategy and how to get out of it. Like, you know, what time to get out, what time do I get, when do I get into these earnings trades? You know, is it 3-4 days in advance? I talk about all that stuff in these webinars, the exact time I like to get in. And if you watch me on Twitter, I will tweet out the underlines I'm implementing option strategies on, but I'm not giving exactly the strikes because, you know, I want you guys to have that information, and by watching those earnings courses, you'll know exactly where I'm going in. And then I'll talk about those in the daily market commentaries the next day. The reason why I don't talk about those in the daily market commentaries is because I don't know exactly by the time I get to daily market commentaries where I'm putting those on. So, like, if you guys have enjoyed my webinar, especially if you're one of my regulars, or if you even learned anything at all from this past webinar that you didn't learn online or had never heard before, for this price, you guys are getting a great deal, and you should take advantage of it, because the only way to get better as a trader is to constantly learn, which you guys have obviously made that effort by doing this. But if you've ever wanted to trade options in and around earnings, this is the course for you. And you know, last week somebody was like, yeah, earnings are kind of a crapshoot. Well, in a sense, but when you're playing probabilities, the probabilities are you're the house on the crapshoot now. If you play craps, the probabilities are in the casino's favor, and that's what you're doing when you're trading these earnings events in and around with my setups and with my rules. You know, I talked about this right before this webinar, if you were on early enough, that I had 4 options strategies on for 4 different earnings this week, and all 4 of them I was directionally wrong. Am I proud of that? Well, yeah. You know why? Because I made money on all of them because of the volatility crush, you guys. That's the beauty, and when you set up the earnings in and around the way that I teach it, is that I was directionally wrong, you guys. And I'm not claiming I know the right direction of everything, but what I do know is probabilities, and I know when things are, I have a gut feeling, pretty good gut feeling, which I try and, you know, teach you guys how to kind of get that feeling, what direction it's going to go. But am I right every time? No, I was wrong 4 out of 4 on that directionality. But because I set it up correctly in high probability trades, I won 4 out of 4. Okay, so that's what it's all about. It's not about being directionally right all the time. It's about knowing the right way to put trades on and knowing how to trade options. And that's, I teach that. You know, you can go online and, like I said, you can read about how to do a long call calendar. I'm not going to lie, but they aren't going to tell you you need to be buying that one in an options earnings cycle. You need to be buying that when there's super low implied volatility. You need to know how there's a separation between the volatilities of each of these so that you know whether or not you're paying too much for volatility. So I teach all of that stuff in all my webinars, and especially in this earnings one. So you guys really could take advantage of that. I mean, at the end of the day, you can trade with technical analysis. You can build any kind of strategy, but the way to get ahead in this game is to trade with probabilities and become more mechanical. And that's another thing that I didn't mention. Anyone can teach you how to build a strategy. Anyone can teach you how to trade charts, but the charts aren't always right. Believe me, I can read charts too, and they don't always work out. But I teach how to play the probabilities, and when the probabilities have gone against us, how we stay mechanical and increase those probabilities even further, creating more alpha. You know, not every strategy works my way, you know, but when they don't, I go through in detail as to how to stay mechanical and how to keep in that trade, how to, you know, trade around that loser to create more credits, create more opportunities, and bring that back into a positive. Okay. There are times where I just pull the ripcord on it. You know, it doesn't work out. I pull the ripcord. I'm not gonna ride it out and keep being mechanical about it. But sometimes I do when I'm still pretty sure about my directional assumption and it's gone against me, how I've been mechanical, collect more credit, get out for a profit. So I've done that with several of my stocks in the past. So stick with that, you know, that mechanical thought process. It's all about probabilities, you guys. If you're thinking about trading as money, you're too emotional. And when you start thinking about probabilities, you're going to be able to sleep at night. And that's how I teach this, is to think about probabilities, not as money, okay? We're talking about percentages of increases, percentages of decreases or drawdowns, and when we get out and we stick to that. So we're offering this trial today. Oh, shoot, I forgot to put it in. Thanks for reminding me. It's in the chat window, you guys. Sorry. Put this in the chat window. So this link right here, if you're watching it on delay, you weren't going to have the opportunity to get to that. Actually, I sent that to myself, to the entire audience. There you go. So it's in the chat window, you guys. We've been discussing back and forth in the questions box. There's a little chat window. You can click on that and get to that offer. If you can't see it, let me know, because I sent it to myself like 3 or 4 times. Thanks, David. I appreciate it. So anyway, the other thing is, somebody was asking about the daily market commentaries. Reach out to us at trading@protraderstrategies.com. We can get you set up with that, or call us at 310-598-6677 for that, and or if you have any other questions. Just want to thank you guys all. Later webinars, we'll be drilling down on different options, strategies, different components, when and where I find them appropriate. Here's also a link. It is a dead link. You'll just have to pause the video, write it down, or punch it into a URL. And I want to thank you guys again. If you have any questions, contact us at 310-598-6677 or email us at trading@protraderstrategies.com. But make sure you guys get set up with those daily market commentaries and this earnings. This is my favorite time of year, or of the quarter, I guess. I love trading options in and around earnings. It's you're in and out. You don't have to sweat it out. All right, take care, guys. Have a good weekend. If you can't take that, take it easy. JQ, I beat you this time.